can you tell us about your strategy, like a value add strategy? Because I'm imagining that the only way you're able to use other people's money, or not the only way, but one of the ways that you're able to buy such a large portfolio with only $120,000 of your own money, is that there has to be opportunity for you to increase the value of the asset enough where you can make it. Can you tell us about how the value add opportunity plays a role in the assets that you're buying, and how that benefits investors as well too, that you work with?
Yeah, absolutely. And if you take a look at single family, right? You buy a distressed single family house. It's all beat up. It's a motivated seller. It needs a bunch of TLC. And you go in, you renovate it. You put in a new kitchen, new bathroom, new fixtures, new paint, new flooring, landscaping, everything. And all of a sudden the value increases. And you've created, through sweat equity, a bunch of value in that property. Now, single family is valued based on the house down the street that just sold, and what, like, the comparable approach is what it's called. Multifamily and commercial real estate's all valued based on the income approach. So it's based on what is the income minus the expenses equals the net operating income. And then there's a multiple of that it will sell for in the market that you're in. So that multiple will change based on you being in California or Georgia or Ohio or Texas or wherever. But essentially it's very predictable based on income and expenses of what a building is going to be worth once it's stabilized, once you go through the value add process. Because you can run rents and figure out what the income is going to be based on just looking at rental comparables. And so you can look at what is the building across the street rent for, and are those units nicer or not as nice as what you're going to put into your building, and you could figure out what the income number is pretty easily. Then you could figure out the expenses by looking at the current expenses of the current seller, plugging in those numbers. And there's some other numbers. You can talk to the management company to figure out the management fee is going to be. Shop insurance around, actually get a quote before you ever buy the property. You can get, look at the actual utility bills and potentially see if you can save some money on those utility bills by putting in LED lights and low flow water fixtures and things like that. Property taxes is a pretty straightforward number. You can just look that up in the county auditor's website. So taxes, insurance, utilities, maintenance. I'm renovating everything. I'm putting on new roofs. I'm putting on, fixing the parking lots, making sure the mechanicals have at least 10 years of life. So that way I have very predictable maintenance schedule on an ongoing basis. So, you take the income, subtract out the expenses, it leaves you with a net operating income. And then based on, me investing in Georgia, I know that it'll appraise for around a 6% cap rate. So now I know exactly what that stabilized after repair value is. And then I back into the numbers the same way that I back into it from a single family standpoint, right? Hey, if I'm gonna buy a house and it can sell for 200 grand and I need to be all in for 70%, okay, great. That means I have to be all in for 140 minus the renovation cost of $50,000, means my maximum allowable offer is $90,000. I do the exact same thing in apartments. I just add some zeros, right? If the building's going to be worth $10 million, I need to be all in for $7 million. It's going to cost me 1.5 to renovate it. So my maximum allowable offer is going to be $5.5 million, right? It's the exact same thing. It just value, like the after repair stabilized value is found in a different way based on the net operating income versus just some comparable approach of, what houses are selling for down the street.